The market has been all over the place these last few weeks, pushing several high-quality names to fresh 52-week lows, creating some intriguing opportunities for dividend growth-minded investors. I'm Nick, and this is the Dividend Growth Income channel. In today's video, I'm highlighting 3 popular dividend growth stocks that are trading at what looks to be a discount. We'll break down their fundamentals, dividend safety, growth potential, and long-term outlook to answer the big question, are these a buy right now? And if you enjoy finding undervalued dividend growth stocks, the kind that make you richer every single year, make sure to like, subscribe, and hit that notification bell so you don't miss future opportunities. Let's dive in. First up at a 52-week low is none other than Microsoft, ticker MSFT. This is one of the largest companies in the world, boasting a near $3 trillion market cap. Microsoft is the global technology giant, developing and selling a wide range of software, hardware, and cloud services. Their products include Windows operating systems, Microsoft Office, the Azure Cloud Platform, LinkedIn, Xbox Gaming, and of course, they are a leader in AI technology. This is one of the few companies with a AAA credit rating, a distinction shared with just a handful of corporations worldwide. At the time of publishing, shares of Microsoft have fallen 10% year to date, and is now sitting at a 52-week low of $378. But let's put that into perspective. Over the last 10 years, investors in Microsoft have nearly 10x'd their investment. Compare that to the S&P 500's 224% total return in the same time frame. And speaking of the S&P 500, Microsoft has been a major driver of this index, making up nearly 6% of the entire index. Just because a stock is at a 52-week low, it doesn't automatically mean it's a bargain. So let's break it down. We have a PE ratio currently at 27.5, which is high, but it's well below Microsoft's 5-year average of 31.7. So if this PE were to revert to its more typical range, we would expect a share price between $393 and $480, suggesting that Microsoft is currently undervalued by PE ratio. Now let's check the dividend yield theory valuation. We have a current yield of 0.88%, right in line with a 5-year average of 0.86%. So by dividend yield theory, Microsoft is more at a fair value. Not necessarily a screaming deal, but also not overvalued. Personally, I'm going to give more weight to the PE mean valuation, at least for Microsoft, but it's good to see both metrics. And as a dividend investor, at first glance, at 0.88 yield might not seem all that useful. If you need income today, maybe the stock isn't for you. But if you do have time on your side, I think Microsoft is the model of the perfect dividend growth stock. Look, if you looked at the yield on cost over the last 10 years, you bought Microsoft 10 years ago, your yield on cost today would be around 8%. So why is that? It's because Microsoft has consistently grown both its value and has raised its dividend significantly over the last 10 years. We have a 5-year average annual dividend growth rate of 10.3% per year. The latest raise back in September is right in line with that average. And we have 14 years of consecutive dividend growth. Microsoft pays out quarterly in the months of March, June, September, and December. Their current payout per share is 83 cents per quarter for a total annual payout of $3.32. The next dividend date at May 15th is going to be payable on June 12th. In terms of dividend safety, Microsoft is as safe as it gets. We have a Simply Safe dividend score of 99, making a dividend cut highly unlikely, an earnings payout ratio of 24%, and a free cash flow payout ratio of 32%. So there's no concerns at all with their dividend coverage. And look, these earnings per share and free cash flow per share charts tell you the story themselves. This is what you want your companies you invest in to do. Microsoft hasn't bought any shares back in the last couple years, but they're not diluting their investors either, and the outstanding share count is down from 8.25 billion in 2015 to 7.47 billion today. Return on equity is at 34%. Return on invested capital is at 29%. Both of these are far above the minimum threshold we want to see them at. It's an insanely profitable company that allocates capital efficiently. You can't really find much to complain about with Microsoft. Debt is minimal at 0.19 net debt to EBITDA and a 9% net debt to capital. In fact, before a couple years ago, Microsoft had more cash on its balance sheet than debt, but they have increased their capex over the last few years. Now, the average Wall Street annual price target for Microsoft is $506.24. This represents about 33.64% upside from today's price. Now, at the end of the video, I'm going to go over what I think of each of these companies as an investment right now and which ones I am currently buying. But needless to say, Microsoft checks off all the boxes. Stock number 2 is the Target Corporation, ticker TGT. Target is one of the largest retailers in the US, selling a wide variety of products via its stores and online at Target.com. Target is also known as a dividend king, as it has more than 50 years of consecutive dividend increases. Talk about consistency. Combine that with a resilient business model that benefits from strong brand loyalty and a diverse product mix, we have an interesting looking opportunity here with Target. Though it's definitely had its share of issues, short-term headwinds like inflation, retail shrink, and a changing consumer spending habit. 2025 has not been kind to Target and its shareholders. Shares are down over 23% year to date just in 3 months. At the time of publishing, the stock is sitting at a 52-week low, just over $100. This certainly grabbed my attention. It's been a rough ride for Target, especially since 2022. The stock saw a huge surge during the pandemic, as many of these kind of stocks did, but now it's come crashing down, and it's only 8% higher than it was trading 5 years ago. And to put things into perspective, over the last 10 years, Target's total return has been just 61%, compared to the S&P 500's 224% total return in that same time period. So the question is, could this present an opportunity to potentially make some money on a turnaround play? But if we look at the PE ratio, we see that it's as low as it's been in the last 5 years, currently sitting at 11.3. Compare that to the 5-year average of 17. So if the PE ratio would revert to something closer to its historical norm, we'd be looking at a Target share price of $140 to $171. Now let's turn to the dividend. Target currently has a dividend yield of 4.3%, which is well above the 5-year average yield of 2.61%. So by dividend yield theory, the stock is looking undervalued right now, and you're getting a better starting yield than most investors have had access to over the last 5 years. But there's more to it than just the yield. Target's impressive track record as a dividend king means it's raised that dividend for 53 consecutive years. Over the last 5 years, the average annual dividend growth rate has been an impressive 11%. However, in more recent times, dividend growth has slowed considerably, with the latest raises coming in at under 2%. We'll talk about why in just a bit. The dividend is paid out quarterly in March, June, September, and December, with the most recent dividend payout was $1.12 per share. The next dividend date is at May 14th, with a payment scheduled for June 1st. Shortly after that, we'll see what kind of dividend growth Target announces for its 54th anticipated consecutive dividend increase. Personally, I'm keeping my expectations a bit muted given the challenges the company is facing. Simply Safe Dividends has assigned Target a safety score of 80, which is considered safe. This means a dividend cut is unlikely, though the safety score has been downgraded over the past few years due to the short-term headwinds I mentioned earlier. And looking at the payout ratios, we see that Target is paying out 49% of forward earnings and 74% of its forward free cash flow in dividends. These aren't terrible, but they are higher than we'd like to see for a retailer that operates on thin margins. For context, Target's operating margin is just 5%, and its free cash flow margin is at 4%. Both of these are below ideal, but fairly typical for a company in the retail sector. Now, when we look at the earnings per share and free cash flow per share growth charts, it's clear this has been pretty stagnant over the last few years, and that's exactly why dividend growth has slowed down as well. Now, the question is can things turn around? One bright spot with Target is their shares outstanding have reduced quite heavily over the last decade, down from 633 million in 2016 to 462 million today. Pretty good. While there hasn't been many share buybacks in the last few years due to limited free cash flow, at least the company hasn't been diluting shareholders either. That said, when free cash flow isn't growing consistently year over year, neither will things like share buybacks happen or consistent dividend growth. As for return on equity, Target is sitting at a 29%. Its return on invested capital is at 16%. These numbers are decent enough, but again, they could be better. In terms of debt, Target's net debt to EBITDA is 1.63, and its net debt to capital ratio is 51%. These numbers aren't horrible, but they're not great. They're also not out of the ordinary for Target. And the average analyst price target is $136, representing 31% upside from today's prices. So perhaps there's some money to be made here, assuming we see things improve. This is the company we're going to be watching closer, as it did just find its way onto the Dow Jones Dividend 100 Index, which means it's now part of the very popular ETF SCHD, making up now about 1.8% of that fund after its recent reconstitution. By the way, I've been putting together a reconstitution video as I was recovering from being sick, but I feel like I kind of missed the opportunity to put that out as it flew by, and every other dividend creator out there has already covered this, so I don't know that it's necessary. But what I'm likely to put out is a video that highlights some of the new additions to SCHD and take a closer look at those stocks as individual investments. And look, and Target was a decent part of that, of those additions. So I'll give you my final thoughts on Target, however, at the end of the video, whether or not I see it as a buy right now and who might benefit from investing in Target. But first, let's go over the final stock in our list today. And that stock is none other than Rowe Price, ticker TROW. We're talking about one of the most well-known asset management firms in the world, with over $1 trillion in assets under management. It specializes in actively managed mutual funds and retirement investment solutions, making it a go-to choice for long-term investors. But the company has faced some challenges in recent years, including industry-wide shifts towards passive investing and fee compression. Despite these headwinds, Rowe Price remains a dividend aristocrat with 38 years of consecutive dividend growth, offering a reliable income stream for investors. The stock is currently trading near multi-year lows, with the dividend yield well above its historical average. Let's take a closer look at the numbers. Year to date, shares are down 19% for Rowe Price, placing it right at a 52-week low of $91.10. And sadly today, shares are trading below where they were 5 years ago. That sucks for Rowe investors. Over the last 10 years, we have a total return of just 61%, and compare that to the 224% the S&P has returned over that same time frame. So are we looking at value right now, or is it a value trap? This is the question investors must ask themselves when pondering an investment in Rowe Price. Now, we certainly can call it undervalued, at least in terms of the PE ratio, trading at a forward PE of 10, while the 5-year average is closer to 15. That's quite a drop. So this is about as cheap as an opportunity we've had for 5 years in Rowe Price. And shares would be valued somewhere between $122 and $149 if the valuation came closer back to its historical norm. Then you look at dividend yield theory, also making Rowe look quite undervalued. Today, you can get a starting yield of your shares at 5.55%. Wow, and we've not had this opportunity in the last 5 years. 5-year average yield is 4.02%. Now, up until a few years ago, this was a strong dividend growth stock. Its 5-year compound annual growth rate, or CAGR, is at 10.3%. However, dividend growth has slowed to a crawl over the last 3 years, and just last month, their latest raise was a mere 2.4%. Again, a dividend aristocrat with 38 years of dividend growth. The question for dividend growth investors would be, can they get back to the kind of growth we were seeing in the 2010s up through 2022 before things went south? Rowe does pay out in the months of March, June, September, and December, paying $1.27 per share for a total annual payout of $5.08. The next ex-dividend date is June 16th. Rowe is a well-managed company dedicated to paying this dividend, and Simply Safe Dividends gives them a safety score of 80, rated safe. Note that over the last 5 years, the stock has been downgraded several times, all the way of a score from 99, but still 80 is a solid score, and Rowe is unlikely to see that dividend cut. So there are challenges and headwinds that remain. We'll just have to see how they navigate those. The payout ratios, they're okay, a little elevated from what we'd like to see in an asset manager, 55% of forward earnings, 50% of forward free cash flow. But over the last 5 years, this company has struggled to grow its earnings per share and free cash flow per share, which is why over that time we've seen such stunted dividend growth and as well as fewer share buybacks. But Rowe hasn't been diluting its shareholders either, thankfully, with outstanding shares decreasing from 261 million in 2015 to 223 million today. Not a lot of movement on that front since 2020, a couple million a year, but it's consistent. We can also note that Rowe holds virtually no debt, and this is typical for an asset manager where they run on an asset-light business model, right? It's primarily assets for clients, assets under management, which allow it to operate with minimal fixed costs. So if you want upside, the analysts are predicting a 20% upside over the next year with a share price target of $110.54. So this could be the time to get into Rowe Price. Now let's talk about these 3 stocks and how I see them for myself and for how others might see them. Out of this group, the stock that I'm buying currently, it's Microsoft. I've bought Microsoft for the first time in a few years in my Roth IRA just this last month. Look, I've been holding Microsoft for quite a while. I bought some in the pandemic. I think I bought a little bit before that too. And it's done very well for me, so it's not easy to add to it on such huge gains. But I think the opportunity has finally presented itself. And granted, I also have huge exposure to them across my various S&P 500 fund holdings between my 401k and dividend growth income portfolio, Roth IRA. I have a lot of S&P 500. Even though I'm buying it right now, it's not to say another 10%, 20% drop isn't possible with Microsoft. Microsoft and a lot of other tech companies have really gone up in recent years. We don't know what's going to continue, if it's going to continue to drop, how far could it go. Microsoft does have concerns around increased capital expenditures, scaling back from their data center leases, and increased competition in their cloud and AI spaces. Now, I'm in the camp of hoping that it drops more, and I would not be mad at all if 3 months from now it's 10% lower, even 20% lower. So keep this in mind before you buy. It could still go down more, but long term, you have to ask yourself, do I want to hold this for the next 5 years or not? If the answer is no, there might be better choices for you. If you want income today, Microsoft is also probably not really for you. But I'm more interested in total return and dividend growth at this stage. Which brings me to Target. This is a fine company, and I was pleased to see Target's inclusion into SCHD after its recent reconstitution. As this is evaluated once a year, I'm comfortable with having Target there and holding it. I do have questions about the long-term outlook for Target. Could this become the next Kmart? Even as cheap as it's gotten, I'm just not interested in adding another retailer in my portfolio right now either. And if I was, it wouldn't be Target. Now, that's not to suggest the upside potential isn't there for Target. And there's a fantastic starting yield. If you're in a more income-focused portfolio, I'd be looking at Target differently. So I'll continue to hold it passively in SCHD for the next year and hope those of you who are taking a chance at Target can make some money. And then we have the Rowe Price. There could be some upside to this one. It's a great, reliable dividend payer, and you're getting a starting yield of 5.5%. Now, I don't need much of that at this stage in the game, especially when it has stunted growth. Now, I've been holding Rowe in my Roth for quite a few years, and it really did nothing. So at the beginning of 2025, I sold out of it, thankfully before this recent drop, in an effort to trim some of my lower conviction positions, moved it into higher conviction holdings like Pepsi and Google. Now, could I end up regretting this? Maybe. But I didn't lose any money on my Rowe investment, and I now have a nice growing position in peer company BlackRock Inc. in my dividend growth income portfolio. I think that is a superior investment as far as asset managers go. It's also seen stunted dividend growth. It sees a lot of the same issues, but I think the overall investment thesis there is a better one. But again, if I was investing for income, I would see this differently, and I think this is a unique chance to get a great starting yield and some short-term upside to boot with Rowe. This isn't a company I'd be opposed to owning again someday. It's a great company. I think all three of these companies could serve a purpose in a portfolio. Each one has current issues that we'll need to overcome, and we'll keep an eye on these companies and more as time continues. Thank you so much for sticking around. Let me know down in the comments if you're buying any of these companies right now. So I was away for a couple weeks after a trip, and then I got sick when I got home. And that just created a whole domino effect of various things that kept me away for a couple weeks. But I do appreciate your understanding, your patience with me. As I'm working to get more consistent with my uploads, I was doing pretty good there for a bit, trying to get at least one per week. Now, with that said, I gotta work on that portfolio update video for March 2025. Expect that very soon. And until next time, my friends, keep investing.